welcome to the Common Fund Point of View. I'm Anita Harriton, Head of Client Engagement for Common Fund OCIO. I'm joined today by Chris Quate, Investment Strategist. In this podcast, we look to give you our latest views in 15 minutes or less. So let's get started. Big picture, Chris. Our macro dashboard tracks more than 50 variables that helps us understand the environment and economic conditions. What signals are we seeing today, and what are we at Common Fund watching today, Chris?
Thanks, Anita. If we look at the dashboard, one thing we did is we downgraded employment at the beginning of the year, and we know that seemed early, but we did this because we were seeing more layoffs, job cuts were increasing, and sentiment was really dropping because folks signaled they were worried about future employment. And now, if we look at current conditions, while labor market is still strong, it is slowing. And we can see that in data like quit rates, job openings, temporary employment is down significantly. Household employment is flat and cyclical employment has stalled. The second change we made to the dashboard was to upgrade leading economic indicators, as 6 of the 10 have turned positive over the last 6 months, and global growth expectations are going up. So growth remains fine, but it is slowing as the increase in interest rates is having an impact on the economy as we expected, and it started to hit the lower end consumer in particular. We're seeing that in credit cards, we're seeing that in subprime auto delinquencies. And it looks like the consumer is becoming a little bit more discerning about what they're spending their extra dollars on. And we also see that most fiscal support has been spent down, and folks are using credit cards now at very high rates. And inflation also continues to come down, but we're still not at our goal, at the Fed's goal of 2%. And at Common Fund, we believe that the decline would be a tough haul to go from about 3 to 4% down to 2. We wrote about this in our year-end letter. And some areas still remain high for inflation, particularly on services side, while goods inflation has really gone away. And one large component of inflation that remains high is housing, but we want to be sensitive to the fact that there are timing effects in housing. It takes a while for our calculations in CPI to show it, but we do see in shorter term data, that rentals are coming down. And if I look at our discretionary portfolios, we were overweight, a little bit overweight equities. We've been overweight for about 6 months, so we rebalanced our equity exposure back to neutral. And we did that by selling equities into strength at the end of March. And we put those dollars largely into core bonds, where we're focused mostly on intermediate term bonds. And we're overweight areas where we really think we're being compensated excess yield, right? Such as agency mortgages that are backed by the government. They have high historical interest rate spreads over treasuries, right? And they don't have much, if any, prepay risk now. And in equities, we continue to be biased towards higher quality companies with strong balance sheets, with pretty seeable cash flows. And we also have a bit of a valuation sensitivity. So, and we continue to believe that the equity market participation will broaden out across sectors, and across market cap ranges. And our equity portfolios that we manage for our clients are giving us similar growth profiles with companies, but at discounts in value to the market right now.
Thanks. That's really comprehensive. One of the things we like to do on this podcast is to bring up some frequent questions that we're receiving from our clients. And one of the things we've been asked about lately, which is no surprise to our listeners, is our views on interest rates and our views on Fed behavior. Chris, last time that we talked, you said we think it'll take time to get interest rate cuts. A week ago, though, we saw a lower than expected jobs report, which the market seemed happy about. Do we still have that view, and where do we stand relative to what the market is thinking?
Yeah, thanks, Anita. I'll say yes, we still have that. We still believe the Fed should be in no rush to cut rates. Our view was 1 to 2 cuts, and we're still there. And that's because we still have persistent inflation, we have healthy employment, and no real slowdown. So there's not a lot of motive. There's not a lot of reason to start cutting. The market went from, it's a good question. The market went from pricing in about 6 cuts at the start of the year, where I believe the Fed was saying 3. And now the market's expecting the first cut in November, and about 1.5 cuts is what's priced in. And so the market view and our view is really pretty similar right now.
Do you
And the
think
Fed, by the way, sorry, the Fed is still saying 3. We think that's ambitious.
do you think we'll need to have the Fed cut interest rates for the equity markets to continue going up?
Well, I want to be sensitive that rates do remain important to the stock market, and we're seeing now the correlation now, the 10-year, is negative for equities, especially small caps. And I do think we're going through a period where we're sort of digesting this normalization of rates. But I don't think you need cuts for the market to continue going up. We think there's nothing wrong with higher interest rates if that is what fits the goals around inflation and employment. But most importantly, the market has to believe that the Fed is committed to cutting rates if needed. And we do think that it's highly unlikely, right, that we'll have a hike in interest rates or an increase as the next move. So we do believe the next cycle will be an easing cycle.
What do we think it will take for the Fed to start cutting rates? Like, what do they need to see?
We think to cut rates, they would need to see at least 3 strong inflation reports showing things are improving, right, and inflation's taming. Or they would need to see real deterioration in the employment situation, because we do believe they're going to continue to follow and watch data and react to it accordingly.
Another topic that we know our clients are asking about is artificial intelligence, or AI. For those of you who joined us, it was a major topic at our forum this past March. Chris, how's Common Fund thinking about AI and investing in the opportunity set?
Well, AI is a big area. There are 3 broad areas as we understand, which is really robotics, natural language processing, and machine learning. And we're seeing AI used in many areas with very promising results in areas like healthcare, cloud services, data center optimizations. But it's important, from our point of view, that AI is also not a sector or an industry. It goes across sectors. So we think of it really as an innovation in technology, like the internet, and it will evolve. Where we have exposure most visibly is with our public equity managers. A lot of the largest companies in the world are heavily exposed to AI, and we own stocks that are major players in AI in areas like semiconductors, and robotics, and in advertising, and other areas. On the private side of our portfolios, we have venture capital managers that are deeply involved in early stage AI companies, just like the way they were in the internet, really in the 90s. And on the hedge fund side, what we've done is we have invested a portion of our capital into hedge funds that use a branch of AI, machine learning, and they use machine learning algorithms to analyze vast amounts of data to identify patterns and trends and make trading decisions around securities. And we've been doing this for about 8 years now, since 2016.
So maybe as a follow-on question to that, how do we see AI impacting the economy on a longer term basis?
You know, because it's the easy part is you're saying longer term, and it's hard to say when things take but over long term, we do think AI will have very positive impacts, and it will increase productivity. But it'll take time to adapt and capture all the value add of AI. But we do see some areas, and one area where AI is making a big impact right now is robotics. And it's interesting, we think, to look at Japan, where we have a long, they've had a long history of embracing automation, and they're really at the forefront of using robots for labor because of demographic challenges, because they have an aging population. And so while they're obviously using industrial robots for manufacturing, it's very interesting to see that as a percentage of the workforce, they're also using robots for agriculture, for elderly care, for services sectors, and for education.
Very interesting. So maybe just in closing, what's the most important thing investors should be looking for in the coming months?
Within our dashboard, I think the things that we're most focused on at this point in time is really we need to watch how this impact of higher rates, how it has an impact on credit and potential risk of defaults. We are also watching geopolitical events right now, and we're in election season as well. But I think probably the most important thing we're watching is this impact of higher rates on corporate earnings, because we believe at this, almost always, and at this point in the cycle, earnings really drive equity returns, and they're coming in strong. Profitability has also been good, right, as companies are able to pass on these increases in costs, right, and productivity is strong. So those are the things we're going to be watching. We do think earnings still ultimately lead the market.
Great. Well, that's a wrap for this episode. Chris, as always, thank you for your insights. I look forward to continuing our conversation next quarter.
Yes, thanks, Anita. Thank you, folks.